Welcome to Counttuts. In this lesson, we're going to be going through some examples in doing our debits and our credits, meaning our journal entries, as well as the accounting equation, the application of the same on the accounting equation. We've done a similar example before. You'll find the link to that lesson in the description below, but this one here should cement your knowledge of doing journal entries and of understanding the accounting equation. And remember, by understanding the accounting equations and your debits and your credits, you therefore understand the trial balance much better, and you can prepare it, as well as the statement of financial position, where the application of these principles are very key. So we're going to move a bit quicker here. If you'd like more understanding, you can check out the lesson that I just alluded to, which is similar to this one here, but a different example. Now, when you're doing your debits and your credits, or your journal entries, or your accounting equations, it's important for you to understand what you debit when. And that's where understanding accounts is very important. And if you've been following our work for some time, you know the acronym that we use, and it's one that we use quite often whenever we have to do journal entries, or we have to do accounting equation, or even doing the statement of financial position specifically. And so what is that acronym? Well, it's DEDCLIC. And if you checked out the lesson that I mentioned, you know already what we are referring to here. Otherwise, you'll find links to other lessons that are related to this one here, which will help you understand accounting much better, in the description below. But what is DEDCLIC? What does that acronym stand for? Well, if you already know it, then that's good. It's going to be easy for you. But if it's the first time you're hearing it, I'm going to write it down here, DEAD. That's for DED. And then here on the right, I'm going to write click. So let me just zoom in here so that you can see CLIC. Okay, all right. So what do they stand for? Well, D stands for debit. E stands for what we're going to debit. What do we debit? We debit expenses when they are going up, or when we incur an expense, we debit it. We debit assets as well. And what does the D stand for? What else do we debit? We debit drawings. Okay, and what do we mean by drawings? Well, anything that the owner of the business takes for his own personal use. And of course, the C, I'm sure you already know, it stands for credit. Okay, so we're going to credit. What do we credit? Well, L stands for liabilities, I stands for income, and C stands for capital. And by capital, we mean any investment into the business by the owners of the business. Okay, so by understanding and applying this acronym, it will make your work quite easy. And you'll see as we apply this acronym to the examples that we're going to go through just now, how it makes it easy. And so usually when you have to do your journal entries, or you have to do your accounting equation or your statements, you might want to write this acronym somewhere on top of your paper or on another page, so that you can refer to it as you're going along, to make sure that you are indeed applying it as it is. Because if you find yourself crediting an expense when you've just incurred an expense, and you refer to this, you realize, no, something is wrong. I've done something wrong here, because expenses are supposed to be debited whenever we incur it. So with that being said, let's go through these examples. And as I said, we're going to be moving a bit faster than usual, because we've done examples such as this before in our Accounting for Beginners series. You'll find the links to those lessons in the description below. Otherwise, the example that I alluded to earlier will also be there for you to follow along. And so you can check that one out first, or check this one out and then go to that one and use it as practice. Okay, so let's do the first one. Number one, we have to put down what the source document is, what the account debited is, what the account credited is, and then our accounting equation, assets equals to equity plus liabilities. Okay, so we're going to apply those principles here. So let me just enlarge it here so that you'll see as we go along. Otherwise, you might have to put full screen for you to see clearly if it's hard for you to see. So let's go through them. Number one, the debtor, Mr. Therefore, who owed the entity 7,500 Rand, went insolvent. The entity received 25 cents in every Rand outstanding. The rest of the balance must be written off as irrecoverable. And so you'll usually have a scenario like this, where someone who owed you can only pay you part of the money, and the rest has to be written off as irrecoverable. And so what do you do in that instance? Well, I hope you know there are two things happening there. Firstly, I have to record what I've received, or I'm receiving from this person who owed me, and the balance that will be written off, I have to record that as a bad debt. And so what are the journal entries that are involved here? Well, there are two specific journal entries, if you will, that you'll need to put down. Remember, you can do the two journal entries as one journal entry where you have 3 accounts listed, or you can do them as 2 separate journal entries. Either way is fine. So you don't have to do it one specific way or the other. But if you're being examined and your examiner or your lecturer has said this is how they prefer you to do it, then you can go ahead and do that. But I can tell you that it doesn't change anything on the principle. It's exactly the same thing. So you just want to follow the guidance from whoever is examining you, because that's how they would want to see you do the work. But you can do it in one of 2 ways. So let's explain how you go about doing that. Well, the first one, what is the debit and what is the credit? What accounts are involved? Well, I hope you know that for the one that we're receiving 25 cents in every rand, bank is involved. So whenever you receive money or whenever you're paying money out, I hope you know that bank is always going to be involved. Okay, and for every other transaction that we're going to do, just know that whenever we see money going out, whenever we pay for something, that is, or whenever we're receiving money, it doesn't matter what it's for, we have to put bank as one of the accounts. And so in this case, yes, we have bank as one of the accounts. And remember, bank is an asset, and if you go to our acronym here, what do we do to assets? We debit our assets. So since bank is an asset, we're going to debit bank here for the 25 cents in every rand that we are receiving. And then what are we going to credit? We're going to credit trade receivables. Remember, trade receivables is money that is owed to us by our debtors, and these are people to whom we sold on credit and they are now paying us. Okay, so the 25 cents for every rand, meaning 25% of 7,500, if you want to put it that way, is coming into our bank account, and we're going to reduce what he owes us by the same amount of the 25%. So let's calculate that. Let's do the first journal entry. By the way, the one where we debit bank and we credit trade receivables, what is the source document that is going to be for that? Well, remember, whenever we are paid by our customers, we issue them with a receipt, right, to confirm that they have paid us. So when we're issuing our receipts to our customers, usually what do we retain? Do we retain the original copy or the duplicate? Well, if you're in business, you should know this. You retain the duplicate. If you're using a receipt book, for instance, the one that you write out will be duplicated at the bottom. So you'll tear out the original, give it to the client, and the copy will remain in your receipt book. Or however you do it, you always retain the duplicate. Okay, so we're going to write here duplicate receipt, and this is specifically for the money that we're receiving from our debtor here, Mr. Tefo, who is paying us. Okay, so I'm going to write here duplicate receipt because we're receiving money from them. And then what is our account debited? As I mentioned, bank is involved. We're receiving money into our bank account. Bank is an asset according to our acronym debt click. We debit our assets, so we're going to debit bank. And what are we going to credit? We're going to credit trade receivables. You can either credit trade receivables or debtors control. And in brackets, you can put the name of the debtor, in this case, Mr. Tefo. That's if that's required for you. But otherwise, we don't usually have to do that. But you can put that for the sake of showing who you received money from. If you want to trace it back, you can put it in brackets. But remember, the name of the debtor is not the account. The account here is trade receivables or debtors control. So those words can be used interchangeably. So whichever one you'll put there should be fine. And how much are we receiving? We have to indicate whether it's a positive or a negative. We know that money is coming into our bank account. So our asset in the case of bank is going up, and our trade receivables is an asset. Remember, money that is owed to us by our customers is an asset to us because it's due to us. It belongs to us. We just haven't received it yet. And so trade receivables or debtors control is always an asset. But what is happening to trade receivables? Well, whenever your customer pays you, it reduces how much they owe you, meaning trade receivables is going down, meaning that specific asset is reducing. And so if you look at our acronym here, debt click, whatever is on the debit side, if it's decreasing, we put it on the opposite side, which is the credit side. And in this case, trade receivables is an asset. And because it's decreasing, because we're being paid by our receivable or our debtor, we are putting it on the credit side. Okay, so don't be confused as to why we're putting an asset on the credit side. We're doing so because the asset is decreasing. And so for any of these line items, whenever they are decreasing, you put it on the opposite side. And so what you're seeing here, we're debiting an asset, which is bank, and we're crediting trade receivables, which is an asset as well. So both of them are assets. So we're going to have a plus for an asset, which is bank, and a negative for an asset, which is trade receivables under the asset column. Okay, and the equity and the liability, we're going to have 0. Okay, there's not going to be anything here, so I'm going to put 0 and 0 there. Okay, so let's put our amounts here. How much are we receiving? Well, it's 25 cents for every rand, so it's 25% of 7,500. So I'm going to take 7,500 times 25%, that gives me 1,875. So what I can do here is to put my positive and my negative. Positive for the bank because I'm receiving the money, and then I put it as a negative for the trade receivables. And you can see here my accounting equation still balances, right? Because I have a plus for the bank and a negative for the trade receivables, which makes it 0 for assets, 0 for equity, and 0 for liabilities. So you can see my accounting equation still balances. Remember our accounting equation, assets equals equity plus liabilities. Okay, so we are not yet done with number 1 because we've just recorded the amount that we have received from our debtor. But what is happening here? Well, remember, this debtor went insolvent. That means they can't pay us the remaining. Remember, they only paid us 25% or 25 cents to every rand. So how much have they not paid us? Well, it's 1 rand minus 25 cents, or 1 minus 25%, that is 75 cents. So they can't pay us 75 cents for every rand. So we have to write that down as a bad debt. Okay, and remember, bad debts is an expense account, otherwise known as credit losses. So you may see the term credit losses or bad debts, which is exactly the same thing. Okay, so let's do just that. What is bad debts or credit losses? Well, bad debts or credit losses is an expense account because we are losing out on this money that belonged to us, and now we know we can't receive it anymore because the person is insolvent. And so what do we do with our expenses? Well, look at our acronym DEBT. You can see here we debit our expenses. So we're going to debit credit losses. Okay, so you can write credit losses or bad debts, exactly the same thing. And what are we going to credit? Well, I hope you guessed it. It's easy enough. It's trade receivables, because remember what's reducing? Money that is owed to us by this debtor is reducing. So we're going to credit trade receivables, and you know trade receivables is an asset and it's going down because we can't receive this money anymore. We need to remove it from our books. That's why it's reducing. So we're going to credit our trade receivables. And how much is it going to be? Well, it's going to be 75% of 7,500 rand. So let's calculate that and see what we get. 7,500 times 75%, 5,625 rand. Is this a positive or a negative for assets? Well, remember, trade receivables is an asset and it's going down because we're reducing our trade receivables. So we're going to put it as a negative. What about our credit losses? Remember, I've already mentioned it's an expense. And where do our expenses go in our accounting equation? Does it go under assets, under equity, or liabilities? Well, I hope you know it doesn't go under assets, and it definitely doesn't go under liabilities, because what is liabilities? Well, liabilities is money that we owe to other people, and that has nothing to do with our first transaction. So it's definitely under equity. Remember what goes under equity? Well, I can already tell you now. We've got expenses, as I've just mentioned. Credit losses is one of them. We've got drawings. And on the credit side, we've got income and capital. So whatever is on the credit side increases our equity. Whatever is on the debit side decreases our equity. So we're going to put a negative under equity, negative 5,625 rand, because of the credit losses, which is an expense which we have debited, but it's reducing our equity. Okay, so I hope nothing is confusing here. Usually students assume that debit always means positive and credit always means negative, or vice versa. But no, these are like two sides of a coin. Okay, so debit doesn't always mean positive. For assets, yes, it's positive. Debit means I'm gaining more assets. But for expenses, that's negative. Even though we are going to debit it, it's negative because it's an expense. Okay, and the same is true for credit. Remember, for assets, credit is negative, or it's reducing our assets. But when you're looking at equity, credit is a good thing because we've got income on the credit side. You've also got capital on the credit side. So you just have to remember that. And remember, liability is not affected here because we don't owe anyone anything in this case. Okay, so let's go to number 2. I hope that was easy enough and it made sense. Bought inventory on credit from Altitude Traders for 18,000 rand before a trade discount of 5%. Well, what do we have here? What is our debit and what is our credit? What I'd encourage you to do here, as we do with all our other lessons, is to pause, attempt it, and then once you are done, you can press continue and see and gauge whether you're understanding this concept and you're able to do it quite easier. And if you made mistakes, you'll be able to pick it up quite easily and you'll be able to rectify them and ensure that you don't make them in the future, as opposed to just listening and following along without having tried these questions. Okay, so let's move on with number 2. Bought inventory on credit. What is happening here? What is our debit and what is our credit? Or the first question rather, what are the two accounts involved here? Well, I hope it's easy for you to have identified we have inventory as one of our accounts because we are buying inventory here. And what are we crediting here? Well, one of two things. Whenever you are buying inventory, one of two things will always be credited. You're either going to credit bank, meaning you're buying it on cash, or you're going to credit trade payables. Okay, trade payables meaning money that we owe our creditors, otherwise known as creditors control sometimes, as it would be recorded, but we'll put it as trade payables here. And trade payables is a liability, money that we owe our creditors because we bought on credit. So those are our two accounts. So inventory, where does it fall on our acronym debt click? Well, inventory is an asset. Okay, and you can see obviously we're going to debit our asset inventory. And what are we going to credit? Well, we're going to credit trade payables because trade payables is a liability. Our liability is increasing because we bought the inventory on credit. If we bought it on cash, we would have debited inventory and credited bank. But in this case, since we bought it on credit, we're debiting inventory and we're crediting trade payables. Okay, so what is our source document? Well, we are the ones who are buying, so we definitely are receiving the original invoice, okay, or original purchase invoice, whatever the case is, original credit invoice or original tax invoice. All those terms can be used. So I'm just going to write here original invoice. Remember, whenever you're receiving original invoice, it means you are the buyer, you are the client, you are the purchaser. But whenever you have a duplicate invoice, it means that you are the seller. You've issued the original one to the customer. So always remember that the original goes with whoever the customer is. Okay, and account debited, as we've mentioned, inventory, because inventory is an asset and our asset is increasing because we just brought in more inventory, and we're crediting trade payables. Again in brackets, or you can put semicolon and the name of the creditor, in this case Altitude Traders, would be fine to just trace it if you need to do that. Okay, so what's happening to our asset here? Is our asset going up or down? Well, as we mentioned already, since we are debiting our asset, it's going up. And it's not just because we are debiting it, but it's because we have increased our inventory because we've just bought inventory. So whenever you buy an asset, you know your asset is going up in that regard for whatever you've bought. And what else are we going to have? Well, we definitely don't have equity here because we don't have expenses, we don't have drawings, we don't have income, we don't have capital in this particular transaction. So we're going to put 0 for equity. And for liabilities, well, liabilities is going to be the same amount for the inventory that we bought. But that's where we now need to determine what the value or what the amount is going to be here. Okay, what is the amount that's going to be for our inventory? Remember, you have a trade discount of 5% here. So you're going to record your inventory at the 18,000 Rand, or 18,000 Rand minus the 5% and record a discount. Well, here's how you determine that. And we have a lesson specifically on that, on trade discount versus cash discount or settlement discount. But in a nutshell, if you're given a trade discount, meaning a discount that you're given when you're making the purchase or on the day of the purchase, then you have to remove that trade discount to get the actual value that you bought your inventory for. However, if you're dealing with the cash discount or settlement discount, then you don't remove it from the value of your inventory, but you will record what is called discount received, which is an income. So what is happening here? Since it's a trade discount, we're receiving it on the date of purchase. We're going to remove it from the 18,000 Rand to get the value of our inventory and the value of the money that we owe our creditors, and we don't record any discount. I hope that makes sense. Whenever it's a trade discount, you don't record a separate line item for discount, but if it's a settlement discount or a cash discount, that's when you will have a separate line item for discount received, which is an income account. If you'd like to understand more on that, you can check the link in the description below where we've done trade versus settlement discount. Okay, so let's record our amount here. It's 18,000 Rand minus the 5%, meaning we bought it at 95% of the 18,000 Rand. So I'm going to take 18,000 times 95% or times 100 minus the 5%, same thing, and it will give me 17,100 Rand. And that's how much I am actually going to record my inventory value for. So we'll put it as a positive here because inventory is increasing our assets, but we're also going to put our liabilities as a positive because we've just increased how much we owe other people, in this case our supplier, because we bought it on credit. Okay, so let's move on to the next one, number 3. Sold goods on credit to Mr. Anderson for 6,000 Rand before a trade discount of 2%. The cost of inventory sold to Mr. Anderson amounted to 4,500 Rand. Okay, so there are a few things that you have to bear in mind here. One, we are the ones who are selling, of course. That means we're going to retain the duplicate invoice, okay? Because remember, the original always goes with the buyer. In this case, we are not the buyer. So we have the duplicate invoice. So I'm just going to write here duplicate invoice. And by the way, here where we are recorded for number 1, our credit losses debit and our trade receivables credit, what is the source document here? Well, remember, we're not issuing a document to anyone. It's just an internal recording that we are making here. So I'm just going to write journal. You can also put journal entry or journal voucher to just show that this is an internal entry that you're making. It's not a document that you are specifically giving to anyone. So we're just going to make sure that we put all our source documents for each transaction that happens. Okay, so now we know that it's a duplicate invoice. What is our debit and what is our credit? What accounts are involved here? Well, there are a few things here to mention. One, this entity is using what is called the perpetual inventory system or the continuous inventory system, meaning they're recording inventory continuously. Whenever there's movement of inventory, they do a recording for it. How do I know that? Well, this is an assumption that we're making, but you can see here they've given us the cost of the inventory sold. That means the expectation is for us to record the cost of the inventory. Remember, with the periodic inventory system, you don't record the cost of sales or the cost of the inventory that you've sold, but with the perpetual inventory system, you record that. Okay, if you've not done that yet, if you've not dealt with it, don't worry about it much. Otherwise, if you have, this is a reminder for you. We have a lesson specifically on that as well. You'll find it in the link in the description below, where we'll look at perpetual versus periodic inventory system and what the implications are when you're doing your journal entries. Okay, so all that to say is that with the perpetual inventory system, there are 2 journal entries that we have to do. One is for the sale of the inventory, but secondly is for the cost of sale of the inventory. So we have to do 2 journal entries for this transaction. So let's do the first journal entry. Remember, the first journal entry, you're always recording the sale that you have made. Okay, so you know that whenever you sell, your credit is going to be sales, because remember, sales is an income account. And if you go back to our acronym here, that click, you can see that we credit liabilities, income, and capital. So whenever you sell, you've got sales as one of your accounts, and we're crediting our income account, which is sales. Okay, so I can already tell you here that account credit is going to be sales. Whenever you make a sale, regardless of the inventory valuation method you're using, your sales is going to be the account credited. But what are we debiting here? Well, let's read again. Sold goods on credit to Mr. Anderson for 6,000 Rand. Okay, so we sold goods to Mr. Anderson here. But how did we sell the goods to Mr. Anderson? Did we sell it on cash or on credit? That will determine what we debit. Okay, if we sold it on cash, we're going to debit bank because money would be coming into our bank account. Remember, with the first journal entry, when we're receiving money, we debited bank. So here in this case, if you're selling on cash, you just debit bank. But what are we told? You sold goods on credit to Mr. Anderson. So we didn't sell it on cash, we sold it on credit. And what is increasing? Trade receivables. So we're going to put trade receivables here. Remember, trade receivables is an asset account, and when our asset is going up, we debit the asset. Okay, remember the acronym again: that click, debit, expenses, assets. Okay, so we've got the debit to trade receivables and a credit to sales, and they're both increasing because the trade receivable is going up because we're being owed more now that we've made the sale on credit, and our sales is going up because we've just made a sale. So we're gonna put plus under assets for the trade receivables and plus under equity for the sale. Remember, we have nothing on liabilities because we don't owe anyone anything, so I'm just going to put 0 there. But what is the amount that we're going to record here for the sale? How much are we owed by Mr. Anderson? Remember, we sold the goods on credit to Mr. Anderson for 6,000 Rand. And so do we put the 6,000 Rand or do we put the 4,500 that we are given here? Well, remember, we're told the cost of inventory sold to Mr. Anderson amounted to 4,500 Rand. That's the cost. That's our second journal entry. Remember, when you're using the perpetual inventory system, when you have to record the second journal entry, as I've explained, you will first record the sale and how much you sold it for, or how much you're owed, and then the second journal entry is where you record how much it costed you for the inventory that you just sold. But in this case, let's deal with the first one. Remember, they have a trade discount of 2%. So what does that mean? How much do they actually owe us, or at what amount do we record the sale of the inventory? Well, we're going to record the amount of 6,000 Rand less the 2% trade discount. Remember, we've already explained this in number 2, so it should be easy for you to understand the concept. And as I've just mentioned, we have a lesson specifically on trade discount versus settlement or cash discount. So you'll find it in the link in the description below. So let's put our amount. It's going to be the 98% of the 6,000 Rand because I'm removing the 2%. So I'm going to take the 6,000 Rand times 98%, and that would give me 5,880. Okay, so 5,880. Remember, I need to put that as a positive because our asset is going up, and I also put it as a positive under equity because our equity is going up for sales that we have just made. Now let's record our second journal entry where we are recording how much it actually costed us and the fact that inventory has just left our premises. Remember, this is an internal entry. We are not giving any document to anyone outside our entity, so we're going to call this journal or journal voucher. Okay, so you can write there journal or journal voucher. In fact, let me put the word voucher here just to show you the various ways you can do it. Okay, now what is the account that is debited? Whenever you sell inventory, and this is always going to be the case if you're using the perpetual inventory system, whenever you sell inventory, you're always going to debit an account called cost of sales. Okay, cost of sales is an expense account because it costed us to make this sale. Okay, that is why we're putting it as an expense, and that's why it's always going to be an expense. Cost of sales, always an expense. You're going to debit cost of sales, and we're going to credit inventory. Okay, so we debit cost of sales, we credit inventory. That's always going to be the case, regardless of whether we sold the inventory on cash or on credit, or whether we issued a trade discount or not. Whenever you're using the perpetual inventory system, this is how you do the second journal entry. So as I've just mentioned, based on our acronym again, cost of sales is an expense. That's why you can see it's debited. Inventory, you should already know this. It's an asset, but what is happening to this asset? It's going out because remember, we just sold it to a client. So it's leaving our premises or it's left our premises. So we need to remove it from our books and we reduce our assets by putting it on the opposite side. And in this case, we're putting it on the credit side. And what is the amount for the cost of sales? How much did it really cost us to buy this inventory that we are now selling? Well, we're given the amount here. We're told the cost of inventory sold to Mr. Anderson amounted to 4,500 Rand. So under asset, we're going to put negative 4,500 Rand because we are reducing our assets because inventory has just left our premises. And under equity, remember, as we mentioned, expenses goes under equity. We're going to put minus 4,500 Rand as well. Okay, and we have nothing for liabilities, of course. These are the two journal entries you'll always do whenever you make a sale and you're using the perpetual inventory system. If you're using the periodic inventory system, you don't have a second journal entry. As I mentioned, check out the lesson on the perpetual versus the periodic inventory system if you've done it already. If you have not, then you don't have to worry about it for now. Let's look at the next one, number 4. Mr. Anderson returned goods with the selling price of 900 Rand after trade discount as they were of inferior quality. The cost of inventory returned by Mr. Anderson was 750 Rand. And so, of course, we have what is called a sales return here. They're returning goods that we initially sold to them. So what are we going to do in this case? What journal entry are we going to pass? Well, let's start with the source document here. What are we going to do? Are we going to issue a document to our client? If that is the case, then we're issuing what is called a credit note. Okay, so we're issuing a credit note to our client, acknowledging that we're going to take the goods back from them. Okay, remember, we always issue a credit note if we are the ones who are receiving back what we had sold to our client, and the client would have given us a debit note saying that they're going to return this goods. If you'd like to understand more on debit note versus credit note and all that goes with it, you'll find a link to that lesson in the description below. So the question is, are we retaining the original credit note or the duplicate credit note? Well, I hope the answer is easy for you as we've gone through it and we've explained why we're doing what we're doing. Remember, we're going to retain the duplicate credit note. Why is that? Because we are issuing out the original credit note to our customers, acknowledging that they're returning goods to us. So it's going to be duplicate credit note. So always remember that when we are the one issuing the document, we're going to retain the duplicate, and when we are the one receiving, we're going to receive the original. And what is our journal entry here? Well, we're going to record what is called sales returns or debtors allowance. This is an expense account and it's going to be reduced from our sales value when you prepare the income statement or the statement of profit or loss. You want to take your sales minus the total value of your sales returns or debtors allowance. So I'm going to write here sales returns or debtors allowance, whichever word you choose to use, sometimes written as sales returns and allowances. And then what are we going to credit here? Well, we're either going to credit bank if we had sold it initially on cash and we've just paid out that money back to the client, but in this case the client had bought from us on credit. Remember, Mr. Anderson, if you go back here and if you look at number 3, sold goods on credit to Mr. Anderson. So we had sold to him on credit and we had raised what is called trade receivables. So now we need to reverse the trade receivable for the particular goods that were returned to us. And what is the value of the goods that were returned to us? Well, if you go back here, you will see Mr. Anderson returned goods with the selling price of 900 Rand. So we need to use that amount. Remember, for these particular goods that are returned by him, this is what was owed to us, 900 Rand. And where are we going to put it? Well, is assets affected? Yes, it is, because we have trade receivables, which is an asset, and in this case it's going down. That's why we have credited trade receivables, because it no longer owes us this 900 rand because it's just returned the goods. So under asset we're going to put minus 900 rand. And what about sales returns? What is sales returns? Well, as we've just explained, sales returns is an expense account. We're going to put it under equity. As with all our other expenses, so we're going to put minus 900 rand under equity, and of course we have nothing for liabilities here. Now, are we done? No, we're not, because the entity uses the perpetual inventory system. We need to reverse the cost of sales and the inventory, and it's quite easy for us to do, because in number 3 you can see we debited cost of sales, we credited inventory whenever we sell to our customers, and we're using the perpetual inventory system. And as we have established, we are using that system here. So we're going to do the opposite of what we did there. We're going to debit inventory because inventory is coming back into our premises, and we're going to credit cost of sales because we had initially recorded cost of sales as an expense, but for this particular good that is being returned to us, it's no longer a cost of sale, okay, because we are reversing the sale, if you will. And what are we going to call this? Remember, this is an internal entry that we are making once again, so we're going to call it journal voucher, as we did when we're recording the debit of the cost of sale and the credit to the inventory. So we're going to put journal voucher here. And what is the amount? What did we record as the value of our inventory and cost of sales? Well, we are also given here the amount. The cost of inventory returned by Mr. Anderson was 750 rand. So we're going to put positive 750 rand under asset, because our inventory is coming back up, because the inventory is coming into our premises, the client returned it to us. And the cost of sale, since we are reversing the expense, we're going to put it as a positive under equity, okay? And then we're going to put 0 under liabilities. I hope you're making sense of why we're using the signs that we're using for each of these transactions. Let's look at the number 5. The entity charged the debtor, Mr. Zambezi, interest at 20% per annum for his total outstanding balance of 5,000 rand. This balance has been overdue for 31 days. Assume a year has 365 days. Okay, so whenever we charge interest to a debtor, what are we going to debit and what are we going to credit? Well, I can already tell you, you will have to debit your trade receivables, because how much we are owed by our debtor is going up. So whenever we charge them interest, we debit trade receivables. And what are we going to credit? Well, we're going to credit interest income, because we're earning interest by charging our customer interest. And what is interest income? It's an income account, okay? So let's do just that. Debit to trade receivables and a credit to interest income. Trade receivables debited. Okay, let me write number 5 here. And what we're crediting is interest income. And what is the source document, by the way? What are we doing here? Well, we are charging our customer interest for overdue account. So what are we going to do? Well, do we issue the customer an invoice whenever we charge them interest? Well, we don't usually issue them with an invoice. We'll just notify them of the late payment and the resulting interest that we are charging them. So we're not issuing a separate invoice to them. So this is going to be a journal voucher as well, because we're not issuing the customer the invoice specifically just for the interest that we are charging them. And how much is the interest? Well, we have to do the calculation here. We're told that it's at 20% per annum, but it's only been overdue for 31 days. So we need to compute for only 31 days, because if we take the 5,000 rand times 20%, it's going to give us for the whole year, but it's only been outstanding for 31 days. So we need to charge them for only 31 days. So we're going to take the 5,000 rand multiplied by the 20%, multiplied by the 31 divided by 365 days. And that will give us how much is actually owed to us by this customer, or how much we are increasing their debt to us for, okay? Because we've just charged them this interest. So it's going to be a positive under asset. So I'm going to put 85 rand just to round it up. So plus 85 rand, that is. Okay, under assets, because of trade receivables going up. And under interest income, of course, there is an equity account. Income increases on the credit side, so we're going to put plus 85 under equity, and of course still nothing on liabilities in this case. Let's go to number 6. Purchase furniture on credit for a total purchase price of 75,000 rand. The entity paid a deposit of 25,000 rand for the furniture using EFT. So what is happening here? We're buying furniture for a total price of 75,000 rand. So that's the first thing. So we know that we've got an asset coming into our premises, which is called furniture. So we're going to debit our assets, because our assets is increasing because we've just received this furniture. And then what are we going to credit? Well, there are two things that I'm seeing here, and I hope you've already identified it based on what we've gone through already. And if you're tempted going through the transactions before you continued watching the video, then you should be in a better place to gauge your understanding. We're going to have two credits in this case, right? The first one here is bank, because we paid cash of 25,000 rand, and this is for the EFT that we made, and the remaining is going to be trade payables because we are owing the balance to the seller of this furniture. So let me write here number 6. And what are we going to call this? What is the source document that we have here? Well, if you said original, you're already correct. And what is it original of? Well, it's an original invoice, all right, or original credit invoice, because of the outstanding balance for which we still need to make payment. So I'm going to write here original invoice, okay? And then the account debited, as we've already mentioned, it's furniture. Whenever you buy any asset, whether that is furniture, inventory, machinery, vehicles, buildings, land, you're always going to debit that specific asset, and then we're going to credit how we bought that specific asset, in this case furniture. How did we buy it? Well, we bought it using bank, that's the first one, and the second one is trade payables. Now we need to compute the specific amount. We know furniture is going up by 75,000 rand because that's the value of furniture. So I'm going to put under assets because furniture is an asset account. So I'm just going to switch this two around, put bank at the bottom and put trade payables at the top. You'll see why now, just to make space, because under assets I'm going to put 75,000 rand, or plus 75,000 rather. Okay, for that's for the furniture that has just come in. And then under trade payables, I can go here and see, okay, how much are we still owing for this furniture? Remember, 25,000 rand. In fact, let's just put it down here. We put it as a negative because it's an account credited, bank, money left our bank account, that is. So we put it on the credit side. So we put it as a negative. And how much was it that we paid using EFT? Well, 25,000 rand, as we are told. So put it as a negative. And then under liabilities, the balance would go there, and that's the 75,000 rand minus the 25,000 rand that we paid for in cash. It's 50,000 rand that we're now owing to whoever sold us this furniture. So we're going to put it as a plus 50,000 rand. Remember, it's a plus because our liabilities have just gone up. Sometimes that question comes up, why are we putting a liability as a plus when it's a bad thing for the business, if you will? We are owing other people money, but whenever our liabilities go up, we put it as a plus. Okay, so you just have to take note of that, and that is how we go about doing that specific journal entry. Let's move on to the next one, number 7. And you can see we are moving a bit quicker here because I think you get the gist of the principles that we've gone through at the beginning, and that's why we started off a bit slower to show you how to work around it. Number 7, the entity paid 10,000 rand using EFT for repairs and maintenance on the vehicle of the owner. Okay, so now this is not just on the vehicle, this is the vehicle of the owner. What do we call that? We call that drawings. Okay, whenever the owner uses money for his personal use, or whenever the business pays something for the owner specifically, which has nothing to do with the business, we call it drawings. Okay, so what do we have here? Well, we're going to debit drawings. Remember our acronym debit: expenses, assets, and drawings. So in this case, we're going to debit drawings with the 10,000 rand. And now we're going to credit, we're going to credit bank, okay, because we are making a payment on behalf of the owner. So let's do just that. But what is our source document here? What source document are we going to record here? Well, are we issuing anyone with an invoice? No, we are not. The owner is not issuing the entity with an invoice. The entity is not issuing the owner with an invoice. And so what is happening here? Is this a journal voucher as well? Well, there are a few ways you can treat this. You can either call it a journal voucher, or proof of payment, or bank statement, right, to prove that this payment has been made on behalf of the owner. So I'm going to put here proof of payment. Okay, you can also use bank statement, as I've just mentioned, to just show that you made this payment on behalf of the owner. And then with debit drawings here, as I've already mentioned, remember, drawings reduce our equity. That's why we are debiting it, just like expenses, which reduces our equity, which is also debited based on our acronym. And then we credit bank, of course, here. And then since bank is credited, we've got a negative under bank for 10,000 rand, so negative 10,000 rand. And then under equity, negative 10,000 rand for the drawing specifically. And of course, we have nothing under liabilities for that specific transaction. Number 8, the entity was incorrectly overcharged by 520 rand for telephone during October 2024. Telephone traders acknowledged the error and refunded the entity on the 23rd of November. Okay, so we're incorrectly charged for the telephone account here, and I just want to see the date. We are preparing this for November 2024. So we can see if we're incorrectly charged for the telephone account for 520 rand, we need to reverse that incorrect charge. Okay, so what are we going to do? Well, we're going to reverse it by debiting first of all bank, because you can see here the supplier who's supplying us with the telephone services, telecom traders, acknowledged the error and refunded the entity on the 23rd of November. So we're definitely going to debit bank here because money came in 520 rand, and we're going to credit telephone because remember our telephone was initially debited as an expense, but now we see that it was an overcharge. We need to credit that overcharge by reducing the expense account, in this case telephone. So with debit bank, we credit telephone. So debit bank, credit telephone, and the amount there, since bank is debited, of course we're going to have a plus 520 rand under assets, and under equity, since our expense, in this case telephone, is being reversed, we're going to put it as a plus 520 rand. Remember cost of sales in number 4 that we were reversing because we had goods returned to us. So whenever you're reversing an expense, you put it as a positive under equity because it was initially as a negative. Okay, but what is the source document here? What document are we going to use here as proof? Well, you can either use bank statement or proof of payment by the telephone company. So I'm going to write here bank statement. Okay, so that is the source document here because they're not going to issue us with an invoice. But what you can also get there is an original credit note, meaning they are issuing a credit note for the amount that they have reversed. So they can do that as well. So you just have to check out what the scenario provides, what the information is that you are given. If they say that you were issued with a credit note, then you have to use credit note as the source document. Otherwise, if nothing was provided, then it's either bank statement or proof of payment to show that they have indeed reversed or paid you back the 520 rand. Okay, let's move on to number 9. The entity was charged 240 rand in interest by Balzu traders. This was for an overdue amount owed by the entity. Okay, so we're charged interest here. Remember, when we charged interest to our client, we didn't issue them with an invoice. It was just a journal voucher. That's exactly what we're going to do here, right? We're going to put it as a journal voucher because we need to record the entry to say, hey, we are owing now this amount, and we're passing a journal entry specifically for that. And you can tell here this is going to be interest expense. And interest expense, as the word suggests, expense is an expense account. And remember, our expenses increase on the debit side. Remember our acronym once again. And then what are we going to credit? We're going to credit trade payables. Okay, trade payables, because now we are owing more to our suppliers because they are charging us interest. So that's going to add to what we are owing our suppliers. And what is the amount here? Well, let's go back. Number 9, 240 rand. So we're going to put 240 rand under what? Is interest expense an asset? No, it's not. It's an expense. Is trade payables an asset? No, it's not. It's a liability. So for the first time, we have 0 under assets there, and then under equity, we've got minus 240 rand because we've been charged interest, and under liabilities, we've got plus 240 rand because our liabilities have just gone up. Now we are owing more to our suppliers, and you can see our accounting equation still balances, right? Assets, which is 0, equals to equity plus liabilities, and you can see under equity is a negative and under liabilities is a positive, so they cancel each other out. Okay, and that's always going to be the case, by the way. Just watch out for that. Whenever you don't have an asset and you have an equity and a liability, then one of them is going to be a negative and the other is going to be positive, and they will cancel each other out, and it's going to be equal to the 0, which is under your asset section. And you need to be checking that the accounting equation still makes sense with each and every transaction that you do. Let's move on to the next one. Number 10, bought stationery for 120 rand using petty cash. This is an easy one. Whenever you buy stationery using petty cash, then you're going to debit stationery because stationery is recorded as an expense, of course, until the end of the financial year, where you have stationery on hand or whatever is remaining is going to be recorded as an asset. But in this case, whenever you buy stationery, you debit stationery as an expense, okay? And that's why stationery would appear in your income statement as part of the operating expenses. But you might also see it in the balance sheet because whatever is left over will go into the balance sheet, okay? So that's just some extra notes for you to remember, okay? And remember, whenever we use petty cash, what do we use as the source document? Petty cash voucher. Remember, we issue a petty cash voucher whenever we use it to make payments. We debit stationery, as I mentioned, and then on the credit side, what do? Well, we're going to credit petty cash. Whenever you make payment through petty cash, then petty cash would be credited here if you have a separate account for petty cash specifically. And how much is it? 120 rand. So we're going to put petty cash as a negative asset. Remember, petty cash is an asset, and now that we are removing money from petty cash, we're going to put negative under assets. Okay, so we're going to put minus 120 rand under assets, and under equity it's minus 120 rand as well because of stationery. Stationery is an expense account, as I've already explained, and under liabilities we have 0. Let's look at the next one, number 11, almost there. Returned inventory which cost 1,500 rand after trade discount of 5% to Altitude Traders. Okay, so now what happened here is that we returned goods to Altitude Traders, and if I stand to be corrected, you can see here we bought inventory in fact from them. In number 2, bought inventory on credit from Altitude Traders for 18,000 rand. So we are now returning inventory which cost 1,500 to them. Okay, so same principle as when customers returned to us their goods. Okay, but what do we debit and what do you credit? We're going to debit trade payables because now we are owing our supplier less money because we've returned the goods to them, so we no longer owe them for that value of goods that we've just returned. So trade payables, okay, is debited here, and that's a liability, by the way, and it's going down. Remember, whenever we debit our liabilities, it's going down. Whenever we credit it, it's going up, as per our acronym as well. And what are we going to credit? We're going to credit inventory because our inventory is going down. Okay, our inventory is going down because we've just removed it from our premises and taken it back to the supplier. And what is the document here? Well, this is going to be the original credit note. Okay, because remember, for us to return these goods, they need to issue us with a credit note, and it's an original credit note. And I hope you got it correctly by writing original and not duplicate, because remember, our supplier is issuing us with a credit note acknowledging that yes, we are returning this goods, so we are receiving the original document, they keeping the duplicate. Okay, so original credit note would suffice there. And what is the amount? 1,500 after trade discount, and we've already looked at trade discount. So under assets, we're going to have a negative 1,500 because inventory has just left our premises. Under equity, we have nothing, and under liabilities, we have a negative 1,500 because we no longer owe our supplier the trade payable for these particular goods. Number 12, okay, second last one. The entity obtained a loan amounting to 300,000 rand on the 1st of November 2024. The receipt of the loan has been recorded correctly, so we don't have to do anything for the receipt of the loan to record it or to do the journal entry because it's been recorded correctly. According to the terms of the loan, interest at 9% per annum is payable on the loan on a monthly basis. Okay, so we need to pay interest on a monthly basis. The entity paid interest on the 30th of November by EFT. Okay, so what is this going to be? We're going to debit interest on loan and credit bank because we've just paid the interest for the first month. And what are we going to call it here? Well, it's going to be, again, proof of payment or bank statement. Okay, so you can put either of those whenever you've made a payment using EFT and you're not necessarily issued with an invoice. And remember, they wouldn't issue us with an invoice. So whenever you pay your bank for the loan that you have, they don't send you an invoice every month. Okay, or you can even say statement, because a statement is usually issued by the bank, but not on a monthly basis sometimes. So you can look around those source documents that you might have to use here. And our debit is going to be interest expense or interest on loan, whichever one of those you can use, or finance cost. In fact, that's another word that's used interchangeably with the interest on loan. And we're going to credit bank here because we paid using EFT. And what is the amount that we're going to record it at? Well, we're going to take 300,000 rand times 9%, but remember this 9% is per annum, so we need to multiply that by 1 divided by 12 to see how much the interest is for 1 month, and it's 2,250 rand. So we need to put that as a negative 2,250 rand as a negative under assets because money just left our bank account, and under equity we've got 2,250 rand as a negative as well because we've just paid this amount of interest. So remember, interest expense is an expense account reducing our equity account, and of course we have nothing under liabilities, so we're going to put 0 there. And then lastly, we have number 13 here. The bank statement showed bank charges amounting to 165 rand. So we've got number 13. And of course, what is our source document for bank charges? Where do we get that? Well, as the name suggests, in the statement we are given bank statement. Okay, so you'll get your bank charges in your bank statement. So I'm going to write here bank statement, or BS for short, and then we debit bank charges. Okay, I hope that was so easy for you. And then we credit bank. Okay, and this is what we're recording in our books. And of course, our bank is going down, so we're going to put it as a negative 165 rand, as we are told, 165. And our bank charges is an expense. It's going to be reducing our equity minus 165, and of course we have nothing under liabilities. Okay, and that's it for all the questions that we had to do. Hope this was helpful. Hope this has helped you understand much better how to do your debits and your credits, or how to do the accounting equation, how to know what source document is and what source document you have to take into account. If you have indeed gained value from this lesson, consider subscribing to our channel, like this video, and share it to those you think it might help. Till next time, cheers.